Hello, welcome to Pearl Lemon Accounting. Today we'll be discussing current assets. What is an asset? An asset is a resource controlled by the entity due to past events and can be used to generate future economic benefits. Examples of these include machinery, vehicles, equipment, buildings, inventory, merchandise. There are many examples of an asset that is used by a company. Now, what is a current asset? Assets come in various forms. Some are tangible and long term, some are intangible and long term, and others are short term as well as tangible. Current assets fall under the short term to medium term category. These are assets that can easily be converted into cash or are already cash. They will be focusing on inventory. Inventory refers to the products the company sells in order to get revenue to continue operating. They are the main idea behind most businesses. They are meant to be sold for revenue. So today we're going to be going through how to account for these in our T accounts so that we can record them in our financial statements. So the first stage of inventory we're going to be dealing with is our raw materials. This is when we get the goods from the farms, like for example, wood. If we are going to be making tables, we need to go get the wood from the wood farm. But then just accounting for the expenses of the wood only is not enough. You have to account for import duties. You have to account for freight, and once you've accounted for all of this, you're going to get a total amount which your raw materials have cost you. And you are going to debit this while you credit your bank if you bought them cash, or you credit your creditors if you bought them on credit. Now we move to stage two. Stage two is when we are in the warehouse. When we are in the warehouse now, the wood is getting turned into tables. It's getting cut, it gets some glue on them to make it a stable table. But this has to be accounted for. So you're going to have your total raw materials for the year, you're going to have your total direct labor for the year, and you're going to have your total factory overheads for the year. And you're going to take these amounts and you're going to put them on the debit side of your work in progress T account, as well as the opening balance from the previous year's work in progress. So now you account for the amount of goods that are left at the end of the year. If at the end of the year in work in progress you have a certain amount, you're going to use that amount as a balancing figure to be able to find out your finished goods on the credit side, because it has to balance the debit and the credit side. So these will be an indication of the number of goods that was moved from work in progress to finished goods. Then this leads us to the third and final stage, which is finished goods. Within finished goods, you'll find the total work in progress for the year, you'll find the total delivery costs for the year, and you will find your total cost of sales for the year. You'll ask yourself, why do we have delivery costs again in finished goods when we had freight and raw materials? That was the amount that was paid to obtain the raw materials, the freight to obtain the raw materials. But these delivery costs are delivery costs to get the goods to the customer. So, as we are looking at the debit side, you're going to have your opening balance, you're going to have your work in progress, and you're going to have your delivery costs. Once you have your total, you're going to go to the credit side and you're going to find out how many finished goods are left. Once you have the amount for finished goods, you're going to use it as a balancing figure to be able to find out your cost of sales. Because, like I said, your debit and your credit totals should always be the same. Thank you for watching the video. Like and comment.